Do you need to put down 20% to buy a house? Well, there's not a clear answer to that one. Yes, in today's crazy real estate market with low inventory, multiple offers, most home sellers are giving more credence to the 20, 25% cash offers than they are to the 5 or 10% down, but that should not be the case. It's possible that the 20% down offer is actually financially weaker than the buyer putting 5 or 10% down. If you're selling your home right now, I urge you to speak to your realtor and to the lender to find out what vetting has been done, how solid the buyer is. The 20% down self-employed borrower might be a weaker offer than the 5% government worker that has a steady, solid income and has been put through more vetting as far as the financial qualifications, including mortgage insurance. This week, I'm going to look at a total cost analysis showing the ramifications, not just cash and payment, but longer term of putting 20% down versus putting 5 or 10 or 15% down. Now, in the total cost analysis, as always, we've got a summary screen showing a purchase, the various loan amounts, different down payments, interest rate, APR, term, payment, of course, and cash to close. And when you click through more info, you'll see a payment breakdown. Closing cost screen shows us a closing cost summary, and the fee detail link gives a line-by-line itemization of estimated fees. But this week, what I want to look at is let's compare a 20% down payment with 5% down payment and the buyer investing the difference in cash. What does that do? Well, the 20% down payment, of course, has a lower monthly payment, but their cash to close is higher. In this example, $600,000 price, about $135,000 to purchase the home. The 5% down scenario has a higher monthly payment, but you can see the cash is greatly reduced, $90,000, same purchase price. Well, what does this mean in the long term? Short term, yes, payments higher, cash to close is much lower. If we look at, and I'm going to change the view here, if we look at the monthly payment, yes, $459 less a month if you put 20% down versus the 5%. 5-year savings, yes, the 20% down will save money over 5 years, about $25,000 over the 5% scenario. The more info button gives a detailed explanation where you can see how much principal and interest is paid, how much principal is paid, the balance remaining at the end of 5 years, total cost, and the net savings. Well, where it gets really interesting is when you start to look at the buyer or the now homeowner's net worth in the long term. In this case, in 15 years, assuming a 3% appreciation in price, the home buyer that put all of their cash into the house up front will have accumulated about equity of $637,000, whereas the 5% upfront homeowner equity is about $575,000. Okay, so the 20% down has accumulated more equity in their home, but the 20% down scenario had no additional savings to invest. And if we took that $90,000 and invested it and assumed just a 6% rate of return over the next 15 years, they'll turn that $90,000 into $220,000, giving a net worth of $796,000 over the 20% down homeowner's $637,000 net worth in 15 years. Which one's better? There's the question. Again, if you click on the more info button, you'll see a breakdown showing estimated value of the home in 15 years, 3% return. The loan balance, yes, it's lower on the 20% than it is on the 15. Total principal paid, yes, it's lower, 20% versus 15. But we look at the investment balance. The 20% buyer has zero. The 5% buyer has accumulated $220,000 in savings. That's where we see the net worth difference. So just another way to look at it. And my message this week is if you're selling your home right now, do not discount the 5 or 10 or 15% buyer. They might be financially stronger. Talk to your real estate agent, talk to the lender, and make a much better informed decision.